capital gains tax is now 45%. Well, it's not quite, but it might not be far from the truth. Check out this video as we go through the details. Okay, my name is Simon Misiewicz from Optimise Accountants, and if you've just taken some Valium, these, by the way, it's ibuprofen, or some Prozac, then you can calm down just a little bit. The intro video is talking about capital gains tax being charged at 45%. Clearly, for the majority of you watching this video, that is not true, even though the media might say it is. It may not be too far from the truth if you're an additional rate taxpayer, or indeed you are selling a property which is a high value. You can be stepped from being a basic rate taxpayer to a high rate taxpayer to an additional rate taxpayer, which has huge amounts of tax consequences. I went through a OTS report step by step through their pages. Feel free to watch that video. The link will be appearing just above my head and in the video description box below as well. That is the report that the OTS, the Office of Tax Simplification, wrote on behalf of Rishi Sunak. So do check out that, because this is very much a presentation view as opposed to a detailed view of that report. And I've also put a link below this video as well for you to have a look at their website. Interestingly enough, the whole purpose, and I'm just going to get to my pointer now, the whole purpose of that report was, according to this, was the Chancellor asked the Office of Tax Simplification, which is Rishi Sunak, to carry out a review of capital gains tax to identify opportunities relating to administrative and technical issues, as well as areas where the present rules can distort the behaviour or do not meet their policy intent. And their policy intent is to create equality. Okay, so that's an interesting, distinct point. Equality. Now, on the flip side, the government are saying that they're entrepreneurial, but then they're saying we want equality. Well, entrepreneurship is not equality. So there's definitely a contradiction in their own policies. And I asked the Conservatives just to wake up a little bit and look at what they're saying, because I have a lot of faith in what Rishi Sunak is doing, but it just feels slightly at odds with what they're saying. So do look at that report. And what they're saying is that the capital gains tax is very small in terms of the income tax. So when they're making these reforms, they're saying, well, let's move this to becoming more like income tax for capital gains tax purposes. And there is some flip charts, but basically all this is saying is, how do we make it fairer in terms of making disposals? And obviously what it's saying here is main challenges with CGT, challenge department with income tax and distortion and making policies. And then we've got different recommendations, which we are now going to go into details. But this chart, amongst others, is in the OTS report, which you can have a look at. Again, the link is below this video. Now, when we look at income tax versus capital gains tax, I think it's important to know where you fit, because you might be looking at this video, thinking about selling a property and think, well, I'm a basic rate taxpayer, it doesn't really affect me too much. Well, maybe not. Because if you are in this basic rate tax band of £12,500 and £50,000 earnings, well then, sure, you're paying 20% tax. But if these changes come into force, which looks like it could do, then any disposals is added to your income. So if you make £150,000 gain on a property that you have sold, which is a buy-to-let property, then you've got to take your, let's say, £50,000 earnings, which is basic rate tax band, add on the £150,000 gain, and wallop, you are straight into the additional rate tax band, which means you pay 45% tax. Now, the majority of people that sell property make between £20,000 and £30,000. And as a result of that, they do not really go too much into the additional rate. They might go from the basic rate tax band to the high rate tax band. So that's an important feature for you to watch out for. All right, so let's have a look at capital gains tax. These are the rates that you currently are charged when you're selling an asset. The first thing to look at is the £12,300 per person. That is the tax-free allowance that you can make. So if you sell an asset and you've got a gain of £10,000, well, lo and behold, you don't have to pay any capital gains tax because it's below the annual allowance, which is great news. As a couple, if you're doing something very clever in terms of the way you do tax planning, you could get a benefit of £24,600, which means you don't pay tax on anything below that number. Now, once you go over that, then there are different tax bands. So if you're selling non-residential assets such as shares, then you will have a 10% tax liability on that gain in excess of your CGT annual allowances, which I've just mentioned here. So in this regard, 10% versus 18% if you're selling residential properties, which I know for a lot of our viewers are focused on property investments, but there will be a majority of people watching this video also that sell shares and other types of assets. Commercial properties also fit into the 10% tax band. High rate taxpayers, well, they will pay 20% capital gains tax rate for any type of assets other than residential property. If you're selling residential property, you'll be paying 28% capital gains tax. Now, you guys might know all this already, but that's absolutely fine. But what I want to do is show you what the difference are of tax rates. I'll do that in a second. Now, this has got a whole section about capital gains tax, and inevitably there's going to be a whole kind of Q&A that needs to happen. I'm going to do a live Q&A on our online platform, which you can register for 28 days. That's this Wednesday at 7 p.m. So feel free to register for 28 days for free. There are a bunch of videos. There are a bunch of Excel templates for you to use. And you can see me every Wednesday as well. And I record each session. So you can access that directly from the tax portal that I have created. So get onto that straight away and I'll see you this Wednesday. The key thing about this report OTS is that consider more closely aligning capital gains tax rates with income tax rates. So that's the first fundamental thing. They're mentioning now capital gains tax and income tax rates together, which is a fundamental change from what we have currently. And then it's got an or statement, which is really interesting because it's not saying it's definitely going to play that part. So even though the media are certainly driving this saying it's happening, well, actually, there's an or statement which would say to me that they are considering other options. What they're saying is consider addressing boundary issues as between capital gains tax and income tax. Now, this is alignment, but this is boundaries. I'm not quite sure what they actually mean by that. But it is certainly looking at it from a perspective of, well, what should we tweak? Now, that's the first point certainly says alignment is a fundamental change. Boundary issues could be what different types of assets that we might look into. Some other recommendations, the annual exempt amount, which is the 12,300 and the 24,600. Well, that looks like it's going to be gone as part of this recommendation. If this is to go ahead, none of this is going ahead, by the way. This is all just contained in a report by the OTS, and Rishi Sunak and the rest of the MPs need to agree and ratify it. The other side to it is consider reforming the current Chattels exemption by introducing a broader exemption for personal effects, with only specific categories of assets being taxable. Well, that's really interesting because Chattels is something that's movable. A chattel is something that if you shake up, and I'll take a house analogy here, but if you shake a house up and down, then it's the things that come to the ground. Chattel could also be cars. So again, could they be looking at the different types of assets that's going to be taxed only and leave some asset types alone, which means that there could be some opportunities for property investors to look at different asset classes. And that's the thing of Optimise going forwards is we are not just looking at real estate investments, we are going to start looking at other types of investments as well. Now, if you're interested in selling a property right now and you want to make sure that you paid only the current rates of tax, then why not download the capital gains tax calculator? I will send a link above my head right now so you can access that calculator and below this video as well. So it'll help you understand what the CGT is, but it also gives you some ideas of how you may minimize that tax as well. All right, so let's have a look at the different rates and how this all compares. And I'll go through this step by step. As I mentioned, CGT is two different rates. You've got 10% and 18% for basic rate taxpayers, and 20% and 28% for high rate taxpayers. And remember that the columns on the right here, the 18 and 28%, is only relevant if you're selling residential property investments. You have the annual CGT allowance of $12,300. So let's compare that now to income tax. Income tax is charged at 20% and 40% for high rate taxpayers. You'll have the annual personal allowance of $12,500. So typically what the Office of Tax Simplification is saying is you've got two lots of annual allowances, and that's unfair for the common person which doesn't sell assets. If they sell some stuff, they will have to pay tax on everything over this first $12,500. They don't have any opportunities for this $12,300. So they talk about scrapping it. So the variance is, well, if they get away with CGT for basic rate taxpayers that sell assets other than non-residential properties, well, they've got a higher tax liability of 10%. But for basic rate taxpayers that's selling residential property investments, they will only pay 2% more. So what's the crying shame about this? Well, as I mentioned earlier, you could easily be moved to becoming a high rate taxpayer, and that's the big issue. So as a high rate taxpayer, let's focus on that for a second. You could easily pay, and by the way, additional rate taxpayers is 45%, so we do need to have a mindset on that as well. But for high rate taxpayers, there could be an uplift from the 20% tax band, let's say selling shares. Now you're selling from 20%, you're going up to 40%. And the other side to that is, as a high rate taxpayer selling residential property investments, you currently pay 28% capital gains tax as a high rate taxpayer. That could be moved to 40%, so a 12% increase. What's fascinating about the OTS report is that they were looking to categorize the changes for different classes of assets. Now, we know that landlords have been targeted for many, many years now with Section 24, the changing of CGT rates, but not for residential properties. So this could be another target on the landlord's back. Not saying it is. I'm sure there will be other things that's going on, but it does feel like it's quite targeted. Don't forget, if you want to book a consultation with us, you can do so. Make sure you can get tax calls now for less than £200. So make sure that you check out the link below and above my head right now and book that call. You do need to use the code YouTube25 in order to get the 25% discount. The call is 265, but you can get it for 198. So make sure you get onto that. All right, so let's talk about CGT, and we'll look at now the specific example here. So we've got sales proceeds of £100,000 of a property, £50,000, which is the base cost, and now we've got $12,300, which is the tax-free allowance. You'll notice that we've got a taxable amount now of $37,700 in the current regime. As a high rate taxpayer, you pay 28%, which is $10,556. So that is the tax that you pay currently if you sell a property before these changes are made. After the tax changes though, well, that could, and I'll say after, if these things are implemented, if, okay, being the key word here, if the sales proceeds is £100,000, base cost is 50. The taxable gain now is 50,000 because you don't have this 12,300. And then you've got this 22,500 as a high rate taxpayer, which is 40%. So you'll notice straight away that what we've got to look at is what is the percentage tax rate of this. It's 11,944, which is an uplift in tax of 23.9%. And the reason why it's higher than just the difference between 40 and 28 is because you lose this annual CGT allowance. So this is an uplifted tax of 23.9% because one, you're paying high rates of tax at 40%, and second of all, you lose the CGT annual allowance as well. So a huge difference if indeed you are looking to sell an asset. What are the choices? Now there is a fourth one, but it's not for regards to sale. And I'll talk about that in just a second. But you could sell now. If you are thinking about selling an asset because it's not part of your portfolio of investments anymore, whether that's paintings, cars, whatever, you might want to sell that property now. Or you might say, well, actually, I don't want to ever sell this property. I'll pass it on to my kids. And that's absolutely fine. You could do that. Or you could leave the country and then utilize your 12,500 personal allowance. Don't forget that if you leave the country, you're still a citizen. And you still get some of the benefits, especially if you're living in Europe right now, albeit that's all going to change. But you could utilize some of your allowances and then leave the country and pay less tax than if you stayed in the UK. So there are the different types of tax. There's many of this, to be fair, but that came to mind straight away. Lots of people talk about leaving the country, and immigration could be a key part to that. So that's really a whistle-stop tour around CGT and income tax rates. I'm going to do more videos on this because there's clearly some connotations around this. The next video I'm going to be doing, which is going to be released next Monday, is focusing on inheritance tax and the changes that this report has had on that as well. So make sure you tune in for that. Don't forget to like and subscribe to this channel and give me your thoughts. I mean, is this going to affect you? And if so, how much is it going to affect you? What are you going to do about it? Has it already affected you psychologically? Then make sure you drop those comments in and I'll do my best to answer and have a conversation with you. Until next time, my name is Simon Misiewicz from Optimise Accountants. I'll see you again soon.